Hey everyone, thanks for joining me for this video. I'm really excited to start a series where I reveal my entire stock portfolio. It's going to take multiple parts since I just have a lot of different names in the portfolio and I want to spend a bit of time on each one of them. So this is part one. Look out for part two, part three on the side if you're watching this a bit after I post it. But I'm really excited to hear if you guys have any thoughts on any of the stocks that I hold, if you guys also hold them, if you love them, if you hate them, what your opinion is on them, and if you have any stocks that you think I should consider that are your favorite stocks that you don't see in my portfolio. So before getting into it, if you like this kind of content, please subscribe to the channel. Would love if you like the video. Let me know your thoughts on the video or any of the stocks I talk about in the comments. Would be great to hear from you guys. So just to get into it quickly, my stock portfolio has 28 stocks in it. For the purpose of this video and this series, I've kind of removed my ETFs, but just high level, my ETFs represent 10 to 15% of my portfolio. So it is very equity heavy. So you're not really missing the big picture or anything by not having the ETFs on this list. You'll see both US stocks on New York Stock Exchange and the NASDAQ, as well as Canadian stocks throughout the portfolio. I do live in Canada, so I do have a lot of Canadian stocks, but I also like to balance out with US companies. Some of my largest positions are actually US companies, as you know, diversifies into a much larger economy, but also the US companies tend to have a broader global presence as well, which is a good mix for the portfolio. In addition to that, as a disclaimer, you'll notice lots of these companies are dividend paying stocks. And we can go into this more in other videos or throughout this video. But I'm primarily a dividend focused investor. And then I just take my dividends, I reinvest in areas of my portfolio where I think stocks are undervalued, or I look at putting that money into ETFs or holding for future buying opportunities. So I like the replenishment of cash into my account, both from me putting in more money, but also from my companies paying me. And I have some other thoughts on dividends I can share in future videos, and why it's a preference of mine to invest in dividend stocks. With that being said, I do have a few non-dividend stocks throughout my portfolio that you'll see. Some of them are just high growth companies that I believe in a lot in the long term. But we'll kind of talk about those non-dividend stocks as they come up. And then lastly, you'll see as we go through the early parts of these videos, some very small positions. Some of them I'm not as familiar with, or don't know the companies too in-depthly because I don't check up on them as much because they're small. Some of them are very low conviction buys that I just have kind of been nibbling into and then seeing how it goes. So I'm not overly bullish on the companies. So I'll give you guys some of that context as we go through this. But I've rambled long enough, so I want to get into my first stock, which is the smallest position in my portfolio, coming in at number 28, and it is AirBnB. So AirBnB is an interesting one. This probably falls into the bucket of one that I've just been nibbling into, seeing how it goes. I want to see more information. The reason I haven't made this a bigger position is because while their margins have been increasing like sequentially quarter after quarter, they haven't been sustainably profitable for a very long time. They have been over the last 12 months, but I want to see how that goes. But overall, the reason I'm interested in Airbnb is because I think they have incredible scale. The ability to sign up any house in the world, pretty much. They operate in tons of countries, like 150, 160, I believe. I think is super powerful. So it's almost like unlimited potential supply if they're able to get those people on board. And I think that's much more powerful than having to like build hotels and put up CapEx and stuff like that. So I think they have a lot of opportunity to scale. And I think we've seen early signs of success in terms of their margins and the ability to add more revenue, add more listings with very little overhead costs. So that really excites me. So I think it's just a good opportunity at a total company level. Now, the company has been expensive. It launched at around like 140, 150 bucks a share, which was crazy in terms of the valuation, even as a revenue multiple. So I stayed away from this stock for a long time. I started nibbling on it as it got to around $100 a share. Then it went all the way down to $80 a share. I averaged down a bit, and that's what I'm in it for. Probably my average price is somewhere in the 90s. So the stock right now is 100 bucks. I'm about flat on it, but it's really a small percentage of the portfolio. So it's really just waiting and see how the company does in future quarters, how their earnings do, and how the stock moves, and then I'll decide whether or not to sell out if the company goes up and I don't think it's warranted, or if I really like the results, I'll add in a bit and make this a bit of a bigger position than 1%. Looking at some of their results, for anyone interested in Airbnb, by the way, I did like a 25-minute business review of them. So you can go find that on my channel. I pulled some of these slides from there. But one of the reasons I like Airbnb is because they are so versatile and so diversified in the type of stay, the type of consumer that they attract. So in any climate, whether people are going to more rural areas, people are going to more urban areas, people are going to very luxurious places, discount places, different hotel chains are exposed very differently. You have a business like Wyndham, which I also did a business review on my channel, much more catered to the lower average daily rates. You have Marriott, Hyatt, companies like that I believe are probably on the other side of the spectrum. Airbnb can thrive in any environment because they have rooms all over the world. You can see even in the top 20% of countries, top 20 cities in the world, such a small percentage of their revenue. So this is a very broad business. And then they also have daily rates going from 50, 60 bucks all the way up to thousands of dollars a night. So just very well positioned and nothing that I think can materially impact their business other than, a pandemic or something like that. In terms of their Q3 business results, we continue to see strong growth on the top line, margin expansion as well. You see net income up 60% without FX, 46% with FX on 30% revenue growth. So it's great to see that scale and operating leverage come into play. EBITDA is just exploding, $1 billion in free cash flow. So the company right here is trading at about a $60 to $70 billion valuation. So $1 billion free cash flow on the quarter, 3.3 billion trailing 12 months. Stock's expensive, but at least it's been sustainably profitable. So we'll see how the earnings grow and how that kind of feeds into the multiple. Going into stock number 27. Now this is a Canadian small cap stock. It's called Diversified Royalty Corp. This one here I started averaging into, and it is a small cap. It's just a Canadian company. It doesn't have a lot of exposure to different countries and stuff like that. So this is one that I plan to keep as a small part of the portfolio. Do I think it can go up from 1.3%? Yes, if I think the valuation makes sense. But this is one that I do like holding. It is a high dividend payer, and that's why part of the reason why they call themselves Div. But I get it. It's also to represent the diversification of their royalty pool. But it is a very interesting stock for Canadians looking for a high income royalty that isn't tied to like something conventional like oil or like food royalty stocks that I went through on a different video as well. So just to go through some of the businesses that they own the rights for in terms of the IP. Their biggest business, that's almost, let's call it 40 to 50% of their royalty revenue, is Mr. Lube. So like an auto body company here in Canada, pretty big, pretty geographically diversified across the country at least. Very stable business, doesn't really get impacted too much based off of like macroeconomics and stuff like that. Because when people obviously have issues with their car and like need to do oil changes and stuff, it has to get done. Some of their other businesses here, Air Miles is a loyalty program. Sudden is a real estate brokerage, low cost real estate brokerage. So I think instead of being with Remax or something like that, if you partner with Sudden, you pay like $70 a month. And I think most of that money goes to the royalty fund here, and you get to keep all your commission. So it's just a real estate arm that can process your transactions, but it's really enabling you to run your own business, and you don't need Remax coming in and taking whatever large cut they do out of those transactions. Oxford Learning Center. So this is like people go there for extra learning, weekend learning, English, math, stuff like that. Nurse Next Door is a very small part of their fund, but I believe they provide in-home services for people who need that, older people. Mr. Mike's Steakhouse. It is what it sounds like. It's a restaurant. And then Stratus is an investment they just made. Actually, they just added Stratus to the royalty pool, and I believe it's a commercial commercial cleaning service. So I think they also operate in the U.S. So they're expanding a bit into the U.S., but not in a big way. Where they clean office buildings, commercial spaces, stuff like that, and they get like 7% of their top line sales flowing into the royalty pool for the strategic investment they made in the business. So you can see here they have a yield of about 7.5%. It goes up and down depending on the performance of the company. Obviously, during the pandemic, some of these businesses were impacted. Think the Steakhouse, Oxford Learning Center wasn't able to operate or open all their locations, stuff like that. So the dividend did get cut slightly, but now it's also back up, and I believe even higher potentially than what it was before. So they move up and down because they pay out 100% of earnings. But this is one that I really enjoy holding as a small position. Gives me monthly cash flow into my portfolio to invest in other things I'm looking at building out. And one that, if the valuation went back down a bit, I would consider maybe making this a bit of a bigger position, but nothing over 2.5%, 3%, just given the nature of the kind of business it is. Stock number 26. So I do own AT&T. This is one, like I said, at these stocks that I only own 1 or 2% of my portfolio with. Some of them I don't have the highest conviction on. AT&T is one of those. This is strictly a valuation play. They're trading at about, I believe, 8 times earnings, 9 times cash flow, something like that. So their returns on free cash flow are in the double digits. The business is somewhat stable. I know there's a lot of moving parts. Their data business in terms of cell phone services is growing pretty nicely, but then they also have areas of their business that are declining. They also have a lot of debt that was extremely worrisome for a couple years. They offloaded Warner Brothers to that merger into Discovery and deleveraged their balance sheet a bit. They still need to deleverage it more, but it seems like they're getting enough cash flow that I'm not overly concerned over the long term of their ability to delever that balance sheet. They pay a good dividend too as they delever the balance sheet, so it's returning a lot of capital to me. It has a very low price to earnings and free cash flow return price on their stock. So this is strictly a valuation play. I don't see how AT&T, which is a national provider, can get down much more to 5 times earnings or something like that. And if they do, I'll take the 20% returns in the short to medium term to hold the stock. So not overly bullish necessarily, but I do think it's at a good price to invest in and get a return on capital. Their stock, like I said, trading, I believe it's closer to 8 times. I think they're going to do 250 to 260 in EPS, and they're at $20. So yeah, 7 to 8 times earnings. They do pay over a 5.5% dividend yield, and I think they make about 14 to 15 billion in free cash flow. So yeah, about 9 times, let's call it, free cash flow. So this is one I don't think the company's positioned for great growth, but I just think at these valuation levels, I'll take the 6% dividend as they pay back debt, and hopefully it can grow into a stronger valuation into the future. This is kind of just their Q3 earnings summary, so you can kind of see some of the figures we were talking about. So this is just on one quarter. They made 70 cents of EPS. Um, some of their businesses are actually growing. So you'll see um, on at least cash from operations grew in the past one quarter. I'm just going off the cuff here, but overall they seem to be holding their own. Not a huge growth company by any means, but they're not in free fall either, especially after they've made divestments like DirecTV. I'm not vouching for the company's performance in the past. I don't think they've been well managed, and they've destroyed a lot of shareholder value from how they've managed the business, buying back tons of shares in the 30s, then taking on more debt for acquisitions that they ended up selling for less. But ultimately, once again, just a valuation play. My 25th stock that I hold is Canadian Utilities. So this is obviously a utility company. Operates primarily in Canada, but they also have a business that they run across the Caribbean. I think they also have some utility assets in Europe and in Australia. But this is one of the oldest companies in Canada. Very reliable company. It's been paying a dividend for, I think, about 50 years, and is one of the only companies that have been increasing their dividend that long in the Canadian market. So this is their stock here. You can see about a $10 billion company. I believe they make pretty regularly around $600 million a year. I think we'll get into that in a minute. But they pay a large percentage of their earnings out in a dividend, and the dividend tends to grow. So 4.7% yield I'm getting on this one, pays quarterly, primarily owns regulated utility assets, so pretty safe, but obviously from a valuation standpoint, very reliant on interest rates, as that's kind of where investors are benchmarking kind of fixed returns based off of. You can see here their adjusted earnings over the last 45 years. So pretty good track record of, never having a year where they have a loss, which is great to see. But then also just over time, they've been able to grow despite things like the financial crisis, despite things that impacted areas that they play heavily, like some issues in Calgary and wildfires in Alberta. And then even during the pandemic, the reality is like 90%, or maybe not 90, but a very high percentage of their business is regulated utilities where they know what they're going to get for the product. So it's not a lot of variance based on rates and stuff like that. So pretty safe business if you're just looking for a company that you're going to get a 4 to 5% dividend on. You'll get a raise every year of a couple percent. It's not going to double anytime soon, but it's also not too risky of a place to park money. This is one of the things I love about the business, even though it's already paying a pretty healthy dividend, 4.5 to 5%. They do increase it every year, no matter what's going on. So, is it longest track record of any Canadian company? 50 years of annual dividend increases. They're very proud of that. They talk about it a lot. I cannot see this changing anytime soon. So your 4.7% yield on cost isn't just safe, but it's almost guaranteed. I don't like using the word guaranteed, but it's as close as guaranteed as you can get to increasing annually and compounding in that way as well. And lastly, their earnings, or not lastly, but just summarizing what we were saying before. So yeah, about $500 or $600 million, give or take, from just utilities. The vast majority of that is regulated utilities, so they know what they're going to get. Luma, I believe this is a program they invested and agreed, made an agreement with the government of Puerto Rico to kind of facilitate lots of their electricity and stuff like that. It was losing money, I think, the first year as they built it out, but it's good to see. It seems like now it's being a profit center, and this is a 15-year agreement they have there to kind of, after I believe it was a bad hurricane, Canadian Utilities went in and pitched to take over the system and provide reliable, strong service to that market. So it's good to see that that's a profitable endeavor. And then energy infrastructure, I think this is probably some of the assets they may have in like Europe and Australia and stuff, but I'm not sure. But everything is kind of turning out adjusted earnings for them. But this is obviously the bulk of the business, and it's the regulated part in terms of how much they're getting paid. So safe company from that level. And then now, lastly, despite their valuation swinging depending on what interest rates are doing, in terms of how interest rates are actually impacting the business, they have most of their debt backloaded into 2035 to 2040. So they have 100 million here, 120 million there. If you look back at how much they're making a year, even if they just want to cover that, I believe after they pay their dividend, they have like 150 million. So they could literally just de-lever over the next couple of years, and they'll be fine to get through that. And then they don't have, this is all mostly fixed debt. So probably lower interest rates that they don't have to be too concerned about. But overall, interest rates aren't going to materially impact their operation as much as just what the market values them at. Okay, going into stock number 24, which I think will be the last one we talk today just for time's sake, but look for part 2 and part 3 videos as I go through the rest of this portfolio and some of the stocks I have higher conviction on. A&W Royalty Fund is another one that is very reliable for Canadian investors. Pays about, I believe, about a 5% dividend yield, pays it monthly, and it's just a 3 to 4% top line royalty that you get every time someone buys food at the A&W food chain. So great business. It's been growing over time. Very reliable business. They keep increasing the dividend year over year, which is great to see. And one other thing I like, and I hold a lot of royalty funds throughout this, as you'll see, is just I love how it's it limits the variables that can potentially halt dividend increases or cause dividend reductions. It's just no money's needed in the operation. If cost of labor goes up, it doesn't really hit the company very much out of royalty level because you're just taking it off of top line sales. Same if cost of goods go up. Same if rents go up. So all these inflationary things that may cause prices to go up, you're just benefiting from the prices being higher because you're getting a percentage of that. You don't have to worry about the operations. So I like that aspect of royalty funds. It's very simple. You don't have to pay a big organization. You don't have stock-based compensation to a great extent or any of that stuff. So I like the simplicity of these assets and how they're strictly designed to return capital to shareholders for you to invest in other things. So going through A&W a bit, $36 a share, 5.3% dividend. They pay out all their capital or all their net income after like royalties and the limited expenses they have to shareholders. So it is getting about a 5.3% return total. You can think of it that way in terms of the cash they're creating. This is one of the few food royalty companies in Canada that are actually growing. So year over the last 20 years, they've opened up new restaurants, and this has really been the main force of dividend growth increasing for the business. So they pay about 16 cents a share now. A decade ago, I believe it was around 9 to 10 cents a share, and they tend to increase it either half a cent or a cent a year, depending on how performance has been doing. Another thing that I like about A&W is lots of their franchisees own tons of locations. So this is a business that can be scaled, and you can have one franchisee kind of maybe not operating, because I'm sure they have general managers and stuff, but looking after a bunch of locations, sharing best practices, driving efficiencies, and it kind of just shows, the successful proposition that A&W is providing franchisees, or else this wouldn't be done and people wouldn't be doubling down and tripling down on their ownership. So it really shows the value proposition that A&W is offering franchisees, which I think bodes well for future growth of locations. So that kind of wraps up part one of my portfolio. Just going back here, you can kind of see, looking at the bottom chart here, that my bottom 5 stocks from stock number 28 to 24 is only about 7 or 8% of the whole portfolio. So as we get closer to the top, you'll see the weightings go up, especially once we get to the very top. I have like over 50% of my portfolio in the top handful of stocks. So definitely stay tuned and Would love your opinion, obviously on these stocks, but also as we go through the ones I have higher conviction in and like putting more of my capital into. So thank you guys for sticking with me through this video. Really appreciate it if you made it all the way to the end. If you like this kind of content, please subscribe to the channel. Look out for those other parts of this video as well if you kind of like me going through the stocks that I own. If you own any of these stocks or you have an opinion on any of these stocks, please leave a comment below. Would love to hear your thoughts. And yeah, I'll see you guys in the next one.